In the 1990s, he created a billion-dollar copper producer. In the 2000s, he launched what would become one of the world's top primary silver producers. And in 2015, he started what he believes will be his third billion-dollar company, attracting shareholders like the Sprott Group, Rick Rule, Doug Casey, and Marin Katusa. This is the one gold stock to research right now. Visit futuremoneytrends.com/investright. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with a special guest today, legendary investor, somebody who's been a teacher to many people and helped many people make small fortunes or maybe big fortunes. Rick Rule of Sprott Asset Management. Rick, thank you so much for joining us.
Thank you for the kind introduction.
Rick, for the past 5 years, I've had the pleasure of interviewing you, but today I'm interviewing you, and gold last week made 52-week highs. I've had the pleasure of experiencing the bear market and being wrong many, many times. Is this the birth of what a bull market would look like in gold?
Well, if it isn't the beginning of the next phase, it's the end of the last phase. I think virtually every time that we've visited with each other about the gold price, what I've tried to leave your listeners with is that the gold price is really counter-cyclical with the U.S. dollar as expressed by U.S. Treasuries. The anticipation that Ms. Yellen couldn't raise the interest rates any further caused the U.S. dollar to at least level out its ascent and caused the price of the U.S. 10-year Treasury to go sideways, too. The Treasuries, I think, have been in a 30-year bull market from a low where their interest rates were at 15% to a high where their interest rates are at 1.6%, measured by the 10-year Treasury. And although I guess real rates could go lower and hence the bond a little higher, it's pretty obvious that with regards to the Treasury market, we're much closer to the top than we are to the bottom, which means that with regard to the gold market, we are much closer to the bottom than we are to the top. Could gold retest downside support? Of course. But my own suspicion is unless the U.S. economy really picks up, unless labor force participation increases, and most importantly, unless real workers' wages increase fairly dramatically, I don't see a rise in U.S. interest rates, and I see the U.S. 10-year bond at least flat and perhaps rolling over, which would be, of course, pretty good for gold.
The negative yields that we're seeing across the world now, I think about 1/3 of central banks, and then the rest are at 0 to 1%. This is mind-boggling for people. In layman terms, Rick, in a way that only you can explain, why in the hell would anyone do something that guarantees they will absolutely not receive their principal?
Well, I think there's two reasons. But one thing is that we're inured to the idea that our governments steal from us. Because what negative real interest rates are is theft. It's a function of subsidizing a big part of society, that is the spenders, at the expense of the savers. And given that there's more spenders than savers, that's politically popular. There is an acceptance, particularly in the developed world, that the spenders need to be subsidized at the expense of the savers, which is a different way of saying the non-productive classes or the less productive classes have a right to feast on the corpse of the productive classes. Certainly, a second thing that we must consider as U.S. dollar-denominated gold buyers is that one response to negative real interest rates in Europe and Japan has been to flood the U.S. Treasury market with investors seeking a higher relative yield. It's important to know that the U.S. 10-year Treasury is a relatively rather than fundamentally attractive instrument. In other words, lending money to a credit like the United States government for 1.6% over 10 years is not ultimately attractive. Nobody would argue that. It's only relatively attractive. The third thing is, of course, that it points to the real nervousness that private money has around the world about the state of debt and equity markets. Maybe people feel that losing 1% or 2% a year in sovereign instruments beats losing 30% in private credit or equity markets. Sorry for that long-winded answer, but
no.
The question required, I think, a thorough response.
Thank you, Rick. Rick, the central banks, the war on cash, it's been going on for a while now, but it seems to be at least being pushed in the media now and from some economists. So it's kind of like, I guess, a tap on the shoulder that this is coming. Are the central banks, with the war on cash, are they just a little too late for the actual benefit of having a cashless society to help their policies in the middle of this, structural crisis that we're in with too much debt and unsustainability with the sovereigns?
No, I don't think so. I think that the central bank policies reflect policies that are popular among the voters, among the spenders, and that is that private wealth that somehow escapes taxation is money that's stolen from people who consider themselves to be entitled to other people's wealth. And I think what a cashless society will do is, although it probably won't recoup a lot of the money that has been safely stashed out of harm's way historically, a number which I suspect is in the trillions, what it will do is increasingly prevent private parties' ability to shelter their own wealth from theft by the Commonwealth. So I think from the center's point of view, what they're doing is not so much enabling them to steal wealth that's already been sheltered, but it will enable them to keep the productive classes from being able to shelter more of their wealth on a going forward basis.
Yeah, and to a certain point, I mean, especially for millennials and Generation Xers, it's already cashless. I mean, I bought, I had something printed at Office Max yesterday, and I used my debit card for a 56-cent transaction. It's already cashless for a lot of people.
Right. I try myself when I'm dealing with small business people and service providers, I always try to use cash. For me, it's a political statement. If the person who provides me with a service somehow forgets to declare the money that came to them, it's very difficult for me to see the harm associated with that, given that my own income is from financial services transactions, which are very transparent. I could never, and of course would never, because I'm a coward, utilize that form of wealth preservation. But I certainly don't discourage it in the course of day-to-day transactions that I have with people that could.
Rick, on silver demand, it's everybody's favorite precious metal, or at least the certainly the dedicated. For silver, you've got demand rising, physical demand, physical coin and bullion demand. The industrial demand isn't exactly falling off a cliff; it's kind of just flat. But you've got the copper mines and zinc mines and these base metal mines shutting down. So does this make silver the metal to perhaps watch over the next 3 or 4 years, where it's in a unique situation where future supply is probably definitely going to go down, but the rise, because of its precious metal aspect, is surging?
Silver certainly responds to increases in the gold price. Silver has been widely called the poor man's gold, both because it's affordable for the industry, for the Indian peasantry, and it also can trade in denominations in advanced markets that are smaller, and it tends to move in a fashion that's leveraged to gold. Always be very cautious about predictions of silver shortage, because nobody really knows how much above ground supply there is. I remember back to the middle part of the 1990s when Buffett announced that he bought 15% of the world's above ground supplies of silver. And of course, the Buffett imprimatur caused the silver price to spike and then get absolutely hammered. The newsletter response to that was that some great conspiracy had depressed the price of silver, which was, of course, idiotic. What happened, in fact, was that there had been a fairly poor harvest in India, and the Indian rupiah had collapsed against the U.S. dollar, even as the silver price had advanced in the U.S. dollar. So for the Indian peasantry, their savings in silver had done exactly what they hoped they would do. They'd gone up in price fourfold, and they had a choice between feeding their family and educating their kids or hanging onto their silver, and of course they sold the silver. The instructive lesson is be very concerned about reports of a shortage of silver. You'll hear reports out of the coin industry that there's a shortage of inventory now. There is not a shortage of kilo bars. There's a shortage of retail product. There's a shortage of 100-gram material. There's a shortage of 1-ounce material. There's a shortage of coin strip, but there's not a shortage of silver. What will drive the price of silver, I think, is investor interests in products like the Sprott Silver Trust or the SLV ETF. Paper markets have driven precious metals markets for 6 or 7 years, and will continue to do that. And I think it was really the formation in GLD units that drove the gold price 10 days ago. That, and of course that $60 up day was classic short covering. And we could get a spike in the silver market as a consequence of momentum traders way short silver in the paper markets, getting that sort of religious experience that we talked about in 2011 when they got off the hook.
Rick, it's so funny you mentioned that, because I was thinking about our first interview in 2011 at the Hard Asset Show, and I was like, the one thing I remember is that religious experience line. Well, I've
been short from time to time myself, various things, and so I've experienced the consternation that comes from being wrong on the short side.
Rick, all these conferences, I mean, they're still pretty anemic. They're definitely off their highs of 2011 and 2012. But the physical gold and silver demand, I mean, we've heard this year after year, big surges, mints having delays because there's so much demand. And that seems like there's a discrepancy if this was like the bottom of a bear market, where here are the mining shares, they seem to be beaten down, like you've said, down 85, 90% and maybe more in real terms. Where the hell is all this physical demand coming from for individual coins if the retail guys won't even show up to a gold conference with Ron Paul as the keynote speaker?
Well, I think one of the things is that the conferences themselves over time haven't done a very good job of delivering value to attendees. I would point out to you, Gene, I think you were present, our own conference, which we took over from a disinterested arm of Agora, has grown from 250 attendees to 400 attendees to almost 600 attendees last year, and we suspect we'll have 800 attendees this year. So the decline in the conference business, I think, has more to do with the value proposition offered up by conference promoters than it does with the state of the market. With regards to the physical demand for gold and silver, it's strong from a historical point of view. But if you think about it from a point of view of gold and silver's market share in terms of the total investing and savings matrix in the world, it's declined really dramatically. The economy and markets are so large that while gold and silver demand is of interest to us, they're still de minimis on a global scale. There's some interesting statistics I have for that, but I forget who the author of the report is. I think it's Morgan Stanley. But Morgan Stanley reported, or somebody reported 2 or 3 months ago, that precious metals instruments and precious metals securities constituted between 1/4 and 1/3 of 1% of the savings and investment matrix in the United States. That compares historically to 8% in 1980 at the top of the prior market, and about 1.5%, which is both the median and the mean statistic for the last 3 decades. In order to revert to mean, the precious metals and precious metals surrogate, equities and debt, securities markets, would have to rise roughly 6-fold. That'll give you, and by the way, that's extremely bullish.
Yeah, that's a flood of buying.
Yeah, I mean, if we talk about China, we talk about India, we talk about all those places. The truth is the world's mouth is the United States. And my understanding is about 24% of the aggregate investment savings assets in the world are in the United States. Quintupling or septupling of demand, which would be what would result from a reversion to mean. In a market that was easily the largest market in the world, would do a truly extraordinary thing. I think the precious metals prices. It's also worth noting that the physical demand we're seeing, the retail physical demand that we're seeing, is cumulative and compounding, meaning that we are seeing a transfer of the ownership of that asset from places like central banks, pension funds, insurance, holders of 400-ounce products, to ma's and pa's around the world. Put in a different fashion, we're seeing the metal go from weak, highly leveraged hands to strong, largely unleveraged hands. And over time, that's bullish. It might not make a difference in 2 months or 3 months, but it could make a very large difference in 3 or 4 years. That isn't to suggest that those retail holders won't behave price responses. That is, it doesn't mean that they won't be profit takers on the way up. But they're not philosophically indisposed to precious metals, which central bankers, by nature of their jobs, are.
Rick, moving to the mining shares as we wrap this up, the big mining stocks are up huge. I mean, Barrick, Newmont up significantly since September and up this year. The good juniors, the high quality ones, I mean, they're not down, or they move up when the metal moves up, but they're not really seeing big sell-offs when the metal has pulled back. Are the mining? I know we talked specifically about the gold market, but what about the shares, the mining shares, especially the big ones?
I think the mining share markets are in a very good position, really for 3 reasons. The first is that some of the lessons that were learned in the bear market, with regards to allocation of capital and stupid mergers and acquisitions, will be fresh in the management mind for at least 2 years. I don't see the capital misallocation that we saw in the beginning of the last decade. In other words, I think that the industry will refrain for a little while from doing something stupid and will actually generate some margins as the gold price increases, something that they didn't do in the last cycle. The second thing is that the generalist investors have been out of the precious metals markets entirely. And the performance of the precious metal shares means that the generalist investors have underperformed the indexes that they've had to crowd back into precious metals, which is why the 2 biggest companies, components of the S&P 500, Barrick and Newmont, were the primary beneficiary of fund flows. Those were generalist investors that bought not because they wanted to, but rather because they had to, because they get paid on relative quarterly performance. Coming down to the juniors, of course, think through what's happened in that market. It fell by half, which is normal in a bear market. And then it fell by half again, which is not normal. And having done that, it fell by half a third time. It's off by 90% in nominal terms. Now, a market that's fallen by 90% in nominal terms can double, and that means it's clawed back 12% of what it's lost. What I'm trying to say is, despite a bit of a run, there's a lot further to go in the best juniors, provided the gold price cooperates.
If somebody's listening to this interview, they have several ways to invest with you as a client, through several of your funds, and then actually they could buy Sprott Asset Management itself on SII. Rick, if you could just kind of go over a few of the things I just mentioned. First off, people being a client, and if you're a high net worth individual, you can also probably take place in private placements, correct?
Sure. We want to have a place in our business for all types of clients. If you don't want to be an active investor but want to participate in our business, you can, of course, own the common shares. SII on the Toronto Stock Exchange, or SPOXF in the U.S. over-the-counter market. If you want to participate in precious metals markets but don't want to take equity risk, particularly if you are a U.S. taxpayer, we believe the best products in the market the best certificated physical precious metals products in the market are the Sprott Physical Trusts, which trade on the New York Stock Exchange. The symbols are PHYS for our gold trust, PSLV for our silver trust, and SPPT for our physical platinum and palladium trusts. For people who want to invest in equities but don't want to take the time to research individual equities, our senior gold ETF, the Sprott Gold Miners Trust, SGDM, is a sensible choice. And for those who are willing to take more risk, but again don't want to do the work and want to invest in the juniors, our Sprott Gold Junior Gold Miners ETF, the SGDJ, would be an appropriate choice.
And just to give people an idea, if they call the Carlsbad office and they transfer their funds or send a wire to you guys and set up an account, and their broker or advisor, I don't know what they're called over at Sprott, but if their broker puts them in a portfolio, how much of a review have you had in the stocks they're picking?
Well, two things. We have a very open and collegial atmosphere here. The broker or investment advisor that you have here is very often a technically trained geologist or engineer. You can see their resumes online. But all of the stocks that we talk about are reviewed by the group. A special offer is that if you become a Sprott U.S. client, any time you want to email me your statement and ask me for adult supervision, I will review that statement. I will do a buy, sell, hold review for any client at any time on stocks that are held by Sprott. And frankly, one of the things that we love to do to compete for business with portfolios that are held at other brokers, and I'll make this offer today to your readers, is if you email me your resource stocks portfolio at contacts@sprottglobal.com, that's SPROTTGLOBAL, I will email you back a ranking of your portfolio with absolutely no obligation to you. On an ongoing basis, of course, I'll do that only for clients. But as a one-off, in an attempt to explain to people the value of the information services that we offer, I'm happy to offer up a no-obligation review of your resource stock portfolio, irrespective of where it's held.
That's very generous of you, Rick. And again, everybody, Rick Rule of Sprott Asset Management. Thank you so much for your time, sir.
Thank you, sir.